Right. Thank you for the patience. They had a little technical difficulty in getting you all online. Anyway, we are continuing our discussion on risk and term structure. As I mentioned last week, this is a very interesting and important area. And you probably aware to the extent that now we are looking at risk structure in the sense of default, liquidity, and tax considerations. Okay, we are looking at the maturity being kept kind of frozen here, but we see the interest rates are different. So the same maturity bonds, but you see the interest rates vary significantly simply because of the possibility of risk, consideration of liquidity, and then the tax considerations. So these are the factors which drive these interest rates to be different, right? So you can see this element where we are trying to kind of figure it out through very interesting aspects of monitoring these risk elements. And we looked at this entire the curve, different interest rates that you have seen across a long duration in US, and you have seen to the extent that the same maturity, but the interest rate structures are different here. And also you have seen different kind of notations in the form of double, in fact, triple A's, BAAs. And then, of course, you can see again US government treasuries and US municipal bonds. And we were discussing about this with a concept called rating. Okay, so we were looking at this with a concept of rating, and you have seen to the extent that we are trying to kind of address or analyze this risk possibility through this default risk consideration. So you know what is default risk is, that is the probability that the issuer of a bond is unable to or unwilling to make interest and the final maturity, that is the face value. Okay, so he is not willing or he is unable. Both elements are important here. So one thing is that some countries would be actually have resources to honor their obligations, but they are not necessarily happy due to various reasons, right? And also, very interestingly, you have to see that payment of interest. You know, bonds have coupons, periodical payments. You have to honor them on time, not even a second after the due time duration. For instance, if it is 24th of a particular month, yes. 1st of a particular month, yes. But not on 2nd or 25th. Okay, and the same applies for the face value. But then there are conventions in the market, let's say holiday treatment. If that 24th or 1st falls on a national holiday, the immediately following business day is applicable. So these are the convention in the market. But what you have to simply see is these default probabilities being factored into the bond element itself. So then that would make a different instruments, bonds issued by different parties to yield different interest rate, although maturities are same. Okay, so then we looked at the concept called risk premium. So that is nothing but I was explaining to the extent where the sandwich spread, right? So you apply more and more butter, you bring in more and more layers, your sandwich will look much thicker and also bigger. But unfortunately, it looks fragile, right? It's tend to be like, you know, fragile in comparison to, you know, more very steady, a very clear sandwich that you can hold into your hand, right? So more and more spreads mean you are basically seeing that risk elements are expanding, increasing. So that's in comparison to so-called default risk-free government bonds, treasury bonds. So over and above treasury bonds, how much you had to pay? That's what this spread is. That's what this risk premium is. So we will look at these elements, and then you have seen the elements in response to behavior in the corporate bonds default probability into a treasury bond. We have looked at these things, right? And then we came to the concept of credit rating. Very interestingly, this credit rating element is now again playing a very significant role in financing across the international capital market. So these credit elements are important simply because countries are no longer financing only through bilateral or multilateral official credit sources, right? Even if you are finances being channeled through those bilateral and multilateral credit sources, you are subject to market scrutiny. Markets are reviewing you, markets are evaluating you, markets are looking at the progress in your economy. So they are more or less linked with these rating considerations. So you can't completely ignore the rating arrangements, or you can purely work on this if you are having various priorities in your economies, right? So you have to see what these rating agencies, in line with the established methodologies in assessing a country's default probabilities. Okay, what this ratings does is they are assessing your economic conditions to come at default probabilities. We will get into that aspect in the following slide. But interestingly, I was explaining to you that the elements of AAA at the very top of this rating structure would reflect the more secured, if not prime, credit rating, right? So maximum safety for your investment. And as you move down this ladder, right, you go below, you find your risk probabilities are increasing, your safety, investment safetiness is reducing to the extent that you become a non-investment grade, speculative, highly speculative, substantial risk, as on it goes on, right? So it goes down considerably below these prospects of investment, attraction of investments from international capital market. So I believe up to this point we came at last discussion, and you all are reasonably familiar. These notations now you see in the screen. Any questions up to this point before I move on and continue discussing the concepts that we are now highlighting? Right. So you see here the elements that we were discussing in our last discussion as well. And now, what is this ratings are all about, right? So these ratings basically look at the timely payment ability. Okay. So I was mentioning default means you are not honoring your interest obligation, and finally the capital, that means the face value at maturity. Okay, but interestingly, the element of timeliness is also brought into the equation. So the rating is an evaluation of the timely payment ability of both interest and capital of an individual or a firm or a government, whatever the debt securities they issue. So the bond ratings are basically looking at the possibilities or the probabilities of these agencies or individuals can honor their obligations. Okay, timeliness is very important. Please don't forget to kind of bring that element into the equation when you are highlighting or answering, because that is very important. You have to pay these obligations, interest obligations, principal obligations on a timely basis. Okay, and this credit rating agencies build upon this rating on your credit history. For instance, now you probably aware to the extent that you have so-called credit information bureaus, CRIB. In Sri Lanka, you have a CRIB, Credit Information Bureau, that keeps individuals or firms credit history, whether they have paid their previous past loans on time, right? Any default. And now the discussion is to extend this credit information bureau into the elements of utility payments also. If you have not honored your payments to the mobile connections, utilities like water, electricity, right? Even any other obligations, even in some countries, municipal taxes, or your history in terms of inland revenue arrangements, that's mean tax consideration. They're expanding this. But interestingly, this credit history says that particular individual or the firm or the government's acceptance among rest of the investor community in terms of he is a credible a borrower, because you borrow from their resources, you borrow from their assets, and you have to honor. So the credit rating agencies look at this credit history, okay, and also they look at your present position, present financial positions. You might have a very good history, but you are now about to bankrupt. So the rating agencies are very worried. They probably look at the financial statements and your obligations and your outstanding balances of payments to other parties, all kind of details in your financial statement, and whether your assets are sufficient to meet these. And also they look at your assets, whether these assets are borrowed assets. Details into your financial position is very important, your present status of arrangement. That's why you look at, when it comes to a government, they look at the budget, your policies in terms of your revenue, in terms of your expenditure, in terms of your deficit financing. And also they not only leave your review at that point, and they look at your future income also. So they look at your future probabilities in terms of having a windfall gain. Some might say we are now looking at oil exploration. We are looking at gold mines. We are looking at ocean resources, right? So there are various investments now in your economy. These elements will bring you unexpected returns in the future. How successful you are to that probability, okay? And also they look at general pattern of your economy's growth pattern and revenue pattern, and also expenditure pattern and your fiscal outlook. Mostly they look at fiscal outlook, how you are looking at medium term fiscal path. Now you might have a budget deficit of 8-9% of GDP, but going forward, how you reduce this gap? Are you going to increase taxes? Are you going to decrease wages and then government expenditure? There are various ways. Are you going to sell some assets, privatization, liquidation of non-strategic state assets? So there are various ways of they are keeping and reviewing these elements, and through which they try to kind of come out to certain model-based evaluations. Also, they have elements of judgment-based evaluation. So there's a formula, they have a structured arrangement, and also they look at other elements like governance, environment, social responsibilities, all kind of things in your economic sphere in terms of coming at a rating. And for that matter, even if you take a financial institution or a firm or a corporation, they get into all these things, okay? So they collect this information, they store and analyze this information, and they summarize and sell this information to the prospective investors. So investors instead of they are doing this exercise by themselves, or inviting or assigning somebody to do this exercise on behalf of them, they look at these rating agencies, rating reports, rating reviews, or they call rating observations. Okay, so then rating agencies present their so-called independent observations analysis. So I said so-called because at times it's not necessarily independent. We have experienced to the extent sometimes the rating agencies being criticized not only in Sri Lanka but across the globe. For instance, 2008-9 financial crisis, the firms that the rating agencies rated as investment grade collapsed on the following morning, right? So where's this present financial position, future direction? So all become raw. But these are like, you know, we should not, just because they have done such mistakes, if not oversights, we should not ignore. These rating elements are very important in today's concept, and you are accessing international capital market, and you have to see how best you can work with these agencies and try to figure it out. Your rating in line with international accepted standards of norm. So then you can borrow, and through such borrowing arrangements, you can also play a role in terms of defining your cost, how much you are paying to borrow over and above US Treasuries. That's the risk premium that you have talked about. What is the spread? US 10-year US Treasury, it's going around, let's say, 1.3% now, right? So it is 1.3%. If you are actually paying 5.3% for your borrowing of 10 years, you are paying 400 basis points spread. Okay, 5.3 means 530 minus 1.3 means 130 basis points. Huh? So 5.3 minus 1.3, it is 400 basis points spread, or 4% you are paying over and above US Treasury of 10-year paper, 10-year Treasury bond to borrow. How about a lower rated country? Could be 8.5%, 10%. So he's paying 8.7% over and above US Treasury. The spread is very big, 4 to 8.7. See, so now the sandwich is much bigger, but sandwich is not steady, right? The pieces try to fall off, right? So this is the way that you have to analyze this. And rating agencies try to present analysis-based outcome, and that outcome is just presented in the form of those 3 letters: AAA, BAA, CAA1, right? So see the way that they are presenting these: AA minus, BBB minus, BBB plus. This element itself gives you immediately, oh, this institution, this government, this individual, his standing is this. So generally across the world, for AAAs, AAs, that's a kind of element of spread. They are looking at, okay, if it is AAA, it should be almost in par with US Treasury. So if US Treasury is buying at 1.3, you also should be able to borrow at 1.3. If it is BBB plus, okay, then it's about a certain spread, let's say 150. So that means 150 plus 1.3, you have to borrow at 2.83% line. So that's the kind of understanding market has established. These levels changes. I mentioned the spread. In some period, this spread widens during the periods of risk, like pandemics, global economic uncertainties. This spreads widen. Then nobody tries to borrow during that period. They try to reduce their borrowing. So it's a very important and interesting element of study. And I believe anybody who looks at these things now would know what's the discussion in most of the financial press with respect to Sri Lanka, because recently Sri Lanka being downgraded by these rating agencies. And through their rating observations, they have increasingly highlighted risk, particularly in terms of the present financial positions and future outlook. Sri Lanka has a very good credit history. We have never defaulted. I'm talking about government of Sri Lanka. So we have never defaulted, but unfortunately, now the debt stock is high. So to borrow new, the elements of risk is factored in. So that requires a huge premium to be paid to investors. Okay, so these elements you have to review, and then of course also see what's government's response to some of these rating actions. And government's response also to great extent fair enough, because some of the rating actions are not necessarily based on merits or information. Some are speculative. Okay, governance structures, these are very absurd conclusions, right? So you have to factor these things, elements, and critically analyze. So that's why you are learning these subjects and try to kind of figure it out, whether these agencies and their rating actions are rational or irrational. So you should be able to. Okay, so we discuss these things now. Any questions? Right. So we are looking at the risk element being now looked at, and then the liquidity. This is also very important concept, and I was explaining to you the relative ease with which an asset can be converted into cash. Okay, so how quickly, how easily, without incurring additional cost, you can convert an assets into a cash form. That is very important element. So sometimes you might have an asset, you are going behind many people to get it converted into cash. And in that process, you sometimes find, because it's difficult to convert into easy cash, you have to incur unnecessary additional costs. Okay, so this liquidity matters in that respect, where your cost of selling the asset that you have, in this case a bond, how quickly you can sell, liquidate your position. Okay, so number of buyers and sellers in the bond market also very important yardstick. More participants, more buyers, more sellers, that market is frequently liquid. Because more the people, more the parties in the market, you find they have different views, right? If it is only few people, the chances that the views also similar. So everybody will be in one side. Everybody in the selling side means nobody is there to buy. So if everybody is selling, the prices would decrease sharply in the bond market. Decrease in prices mean increasing interest rates. So you try to find attractive interest rates, somebody might be there to buy. But unfortunately, if everybody in the selling side, this is what happens at times of financial stress, financial crisis. Markets are all in one side. Everybody is selling, nobody is there to buy. So that's why governments come into play. Counter-cyclical policy measures. I was discussing about this, business cycles, right? So you see that liquidity concept is playing a role here. Okay, so the liquidity also very, very important concept. The liquidity, the relative ease with which an asset can be converted into cash, that's make a lot of sense in this exercise. So the risk structure that you are looking at, same maturities, but different interest rates. That happens because of this element called default probabilities we discussed with rating structure in our previous slides. And now we are seeing liquidity. If the liquidity is low, you find those bonds or those assets have to pay a higher interest rates. The liquidity is high means those assets or those bonds would be trading in the market at low interest rates. More people are there. So this is very liquid. And then you see income tax consideration. You find some bonds or some financial assets has tax breaks, tax exemptions. And some, of course, you have to pay withholding tax. You have to pay a tax for holding that asset. Okay, so if that's the case, you find the buyers add that tax component also into the price. If the tax is 10%, okay, if the interest rates are 5%, so what happens is 10% of that 5% is the tax. So the parties who are trying to buy try to adjust the price 5% plus 10% of 5, that is 0.5%. So the ultimate price they derive is 5.5%. So 5.5% price is lower than 5% price. 5% price is high, right? So you know these elements now. So the tax is an additional expenditure to the investor. So they try to pass this tax to the borrower. So he wants borrower to compensate for this. So there are some assets which has tax over other assets where there is no tax. So you probably seen in the graph that we were talking, chart that we were talking, where the municipal bonds here are at times lower interest rates than US treasuries. You can see here the light green municipal bonds in US, interest rates are lower than US treasuries, US government treasury bonds. Why? US municipal bonds have tax exemption. So to promote US municipal bonds, the US authorities have given tax exemption for earnings from investing in municipal bonds. So more people preferred municipal bonds to US treasuries, where you have a small element of tax. So by that amount, there's a difference. But unfortunately, this consideration has changed towards 2000s and there onwards, because the municipalities also become fragile. Probabilities of default increased, and US treasuries become most sought after financial instrument by all the investors, including foreign governments and foreign central banks. They buy US treasuries as reserve assets. So the interest rates of US treasuries have continuously declined, and actually in today's context, it's about 1 to 1.2% for 10-year papers, 10-year US treasuries, 10-year US treasury bonds. Okay, so you can see these concepts in terms of tax consideration. So what you are basically now looking at is liquidity, tax considerations, and default. So this makes the same maturity bonds but different interest rates. So higher the liquidity, lower the interest rates. Higher the income tax, higher the interest rates, right? Higher the liquidity, the default probability, higher the interest rates. So you can see this. You should be able to now figure it out why different assets, different bonds of same maturity carries different interest rates. US treasuries, very liquid, lower interest rate. Corporate bonds, reasonably liquid, but compared to US treasury, higher interest rate. Income tax consideration, municipal bonds versus US treasury bonds. At times where income tax exemptions were available, municipal bonds were favored and interest rates are lower. Default probabilities, right? The governments can print and pay its obligations. So no default in the eyes of investors. So low interest rates. Whereas corporate, although their balance sheets, their earning capacity, all very good, but still they can default. Anything could happen. So you have to pay additional interest rates to investors. So their interest rates are higher. So you see these probabilities. So you see here in this chart, right? So the tax-free status given to municipal bonds. So people demand more municipal bonds. You can see here in chart 1, because demand curve shift to the right, the price of municipal bond increases. Higher the prices means lower interest rates. So the investors who invest in municipal bonds are actually the people who have come out from investing in US Treasury bonds. So the US Treasury bond demand curve shifts left, shift inward. So you can see the demand curve is now closer to the 0 points. And what you are basically seeing here is the price of US Treasury bonds have decreased. That means interest rates have increased. So this is the tax element playing a role. But I was mentioning subsequently in US, because of the financial crises and all kind of other developments, even though there are tax exemptions and tax benefits in investing in municipal bonds, people started moving into US treasuries because that was very liquid, and some municipalities in US, local governments also in US, had financial stress, financial difficulties. Okay, so those elements played a role in changing the preference by investors. And then you see the risk structure being now taken out of the equation. Right now, you know why same maturities but different interest rates, either due to default probability, either due to liquidity probability, either due to tax considerations. Now you keep that aside and look at the term structure. Risk structure is we studied. Now we look at term structure of interest rates. Now we are looking at these elements, the default, liquidity, and tax. We now freeze them. Those are same. Identical risk, identical liquidity, identical tax. But may have different interest rates simply because time to maturity is different. In term structure, what we are looking at is identical characteristics, but maturities are different. But in risk structure, maturities is identical, but characteristics are different. Okay, so what you are looking at term structure, we take default probabilities and everything is same here. We take liquidity consideration, everything is same here. We look at tax consideration, again everything is same. But then we look at the interest rates, they are different. Why? The time remaining to maturity, term to maturity is different. 5-year bonds interest rates are different to 10-year bonds. But you are looking at everything of US Treasury or Government of Sri Lanka bonds. Government of Sri Lanka's bonds of 2-year interest rate is different to 3-year. 3-year is different to 5-year. 5-year is different to 10-year. In US also same, in India also same. If you take any country, mostly it's same. But the characteristics, risk, liquidity, and tax are same for all treasury bonds. So the element what changes now in the interest rate is the time to maturity. In risk structure, it is the risk premium because of characteristics are different. Time to maturity is same. But here, characteristics are same. Time to maturity is different. Okay? So that is the basic and fundamental difference between risk structure and term structure. Please don't confuse, get it straight away. What is risk structure? What is term structure? The risk structure is maturity is identical, characteristics are different. Term structure, characteristics are identical, maturity is different. Okay? Before I move on to, please make sure you get that point. Any questions? Right. So you see here, to analyze term structure of interest rates, a very, very interesting and widely known and discussed in financial market, a concept called yield curve play a very important role. What is this yield curve? This yield curve is a plot of the yield on bonds with different terms to maturity, different time to maturity, but same characteristics, risk, liquidity, tax. So you plot, you take a 2-year bond, okay, and put a dot. 2-year bond interest rate is 5%. Then you take 5-year bond, you put a dot in the XY bar chart, right? So then you look at a 10-year bond, where the interest rate is, you put a dot. So then you see these dots on particular single day, you probably see 2-year bond is lower, 3-year bond is higher, 5-year bond is slightly higher, 10-year bond is maybe slightly higher or almost same as 5-year bond. So you basically connect these dots. It could be like a straight line because it's the date, same date, even the same time, 10 o'clock in the morning. Then by 2 o'clock in the afternoon, you probably see these rates have slightly changed. But if you are drawing this for a period, different dates, you can always take the date and take two-year bond rate at 12 o'clock in the noon. 5-year bond rate at 12 o'clock in the noon. 10-year bonds at 12 o'clock in the noon. You then connect. So it's a line, but different dates. So it's a behavior of 2-year interest rates. You can see it's a plot. Okay, that plot will show you how it is like a wave it's changing across different time periods. 5-year may be higher than 2-year, 10-year may be higher than 2-year, or 10-year may be lower than 5-year. It's all possible. So when you look at these plots of yields on bonds of different maturities but identical characteristics, this yield curves may be upward sloping. Okay. So this yield curves must be upward sloping simply by taking y axis as interest rate and x axis as term to maturity. So you probably see 2-year, 3-year, 5-year, 10-year, 20-year, 30-year. You can go and grow. X axis could be like that. You can expand it. But the particular yield curve is on that day, and more specifically, particular time on that particular day. If it is 12 o'clock, 12 o'clock, because at 1 o'clock interest rates are different. That dynamic when it comes to financial markets, it changes every time. It changes, right? So then you can see this plotted yield points, okay, either upward sloping. That means long-term interest rates are higher than short-term interest rates. That's why it is upward. It's like a hill that you are climbing, a staircase that you are climbing. The first step is the short term. As you climb up, you are going to the long term. Maturity is longer. So those interest rates are higher. So upward sloping. Curve is climbing up. Then you see the probability that these yield curves could be flat. It's like a floor, rooftop. Short-term and long-term rates are now different. It's same. It's 5%. 2-year also 5, 10-year also 5, 20 also 5. It's flat. Then also you will see inverted yield curves, where the short-term interest rates are higher than long-term interest rates. 2-year rate is 7%, 5-year rate is 5%, 10-year rate is 4.5%. So it is that the slope that you are seeing. You are looking down now. First upward sloping, but now you are seeing something like from where you are standing, you see it's the longer tenors are lower than that. It is inverted, downward sloping. Inverted means downward sloping, where long-term rates are lower than short-term rates. Upward sloping, long-term rates are higher than short-term rates. Inverted or downward sloping, long-term rates are lower than short-term rates. There are various reasons for these yield curves to look like that. We will study, and please understand this yield curve shape itself an indication in many advanced economies, including US, to say that their future economic growth are declining. If not, they are going into recessions. That means negative economic growth. Future is uncertain. These are indications. By looking at the shape of this curve, there are various economic analysis and projections, and it's a true empirical studies. When the rate structure or the yield curve shows an inverted shape, future interest rates, long-term interest rates are lower than short-term interest rates, the markets assume future is not that prospective. Future economic growth is negative. US is heading towards recession. There are various studies that has shown this. And what is interesting here is we will look at these yield curve shapes and how it explains this term structure through various theories. We would look at theories that explain this behavior. Okay, So what you are now trying to see is to study the term structure, where the yield curve is a very important element of understanding of the shape of these different maturities and their interest rates. You already know what is upward sloping, what is a flat, and what is an inverted yield curve is. And you also know what is the yield curve in the first place, right? So you have these elements, and these elements being studied through an understanding through certain concepts and theories. We will get into those in a very simple and straightforward way of understanding. Any questions before I move on? Right. So what you are basically now seeing here is theories of term structure that should explain these facts. There are facts that need to be explained by these theories for us to understand the term structure. When I say term structure of interest rates. Right. First aspect or the first fact is interest rates on bonds of different maturities move together over time. If the short-term interest rates are increasing, long-term interest rates also has to increase. If the short-term interest rates are decreasing, long-term interest rates also has to decrease. The movement of interest rates of bonds of different maturities move together, maybe with a little time lag, not necessarily simultaneously, right? But generally you can see the pattern. When the short-term interest rates have increased, entire term structure also has an element of upward adjustment. We see that if you look at various yield curves that we publish in the central bank publications, annual reports and newspapers, last week yield curve, this week's yield curve, last month's yield curve, last year's yield curve, you see the yields have changed. And sometimes you see the long-term, short-term all adjusted upward. Sometimes you see only the short-term adjusted, long-term has on each other. Last year also that level, this year also that level, last month also that level. Or the adjustment is not the same, but adjusted, but differently. So what you try to understand through these structures is, one element they try to explain is bonds of different maturities move together. When the short term adjusts, long term also adjusts. Either increase, decrease. That's why I said adjust. Then the second point these theories try to explain is, when short-term interest rates are low, short-term interest rates are low means long-term interest rates are high. Okay, so in such circumstances, yield curves are more likely to have an upward slope. Yes, you know what is upward slope? Long-term rates are higher than short-term interest rates. So when short-term interest rates are low means long-term interest rates are high. So in such circumstances, you see upward sloping yield curve. But similarly, when short-term interest rates are high, that means long-term interest rates are low. then what you are simply seeing is yield curves are more likely to slope downward and be inverted. Downward sloping. When the short-term rates are low, yield curves are upward sloping. When short-term interest rates are high, yield curves are downward sloping or inverted. Very simple monetary policy. Why monetary policy wanted to keep short-term interest rates high? Monetary policy is not looking at long-term interest rates because it cannot target long-term interest rates. It's target through various other mechanisms. But it gives overnight. Overnight means one-day interest rate. Today to tomorrow. That's the policy interest rates they decide. So when the central banks increase the short-term interest rate, overnight interest rate, short-term interest rates adjust. Why they do that? When they see inflations are high or inflation expectations are high. So to manage or bring inflation down, central bank increase the policy interest rates. When the interest rate increases, the cost of financing increases. Then people would not be able to borrow as they used to borrow at low interest rates. So that itself reduced the demand in the market. Reduction in demand would reduce the prices. You know what happened, no? Demand curve moves here and there. So that's why when the yield curves, short-term interest rates are increasing, means future, that means long-term interest rates. How the long-term expectation of interest rates being built? Fisher equation we discussed. Expected inflation plus real interest rate. That's the nominal interest rate. Nominal interest rate is equal to real interest rates plus expected inflation. Today's inflation is high means, and the central bank is increasing interest rates today to fight this inflation. That means future inflations are low. So expected inflation in the Fisher equation is low, right? So then long-term interest rates are low. So today's yield curve, short-term yield curve is high and long-term yield rates are low. So then you see downward sloping yield curve. But today's interest rates are, short-term interest rates are low means people borrow and invest, borrow and consume, borrow and demand. So future interest rates could be higher. So then you see upward sloping curve. When short-term interest rates are low, upward sloping. When short-term interest rates are high, downward sloping. So this is another element these theories try to explain. And then there is another concept or explanation that tries to explain yield curves are almost always slope upward, irrespective of short-term interest rates, high or low. Yield curves are.
Excuse me, sir, can you just explain why the central bank is increasing the short-term interest rates again?
Yes, it's a very good question, and I explained to say that central banks are increasing short-term interest rates to fight inflation. Okay, so when inflation or inflation expectations are high, central banks adjust their short-term interest rates upward. So you see, when short-term interest rates are adjusted upward, right? So cost of finance, cost of borrowing is also immediately adjusting the markets, right? So that means borrowing becomes costlier. So people who borrow and do the businesses, borrow and do consumptions, all get reduced when the cost of financing increases, right? So central banks are mindful when the inflationary pressures are building in the economy, at least not to decrease the interest rates if they are not going to increase the interest rates. When they really see inflations are building up, so they tend to increase the interest rates. And central bank increase basically the short-term interest rates. I said overnight. And this spill into the immediate short-term, short-run interest rates. So when the interest rates are increased at the short end, it's naturally push the interest rate curve closer to the 0 point y-axis and x-axis intersects that, right? So higher, and then you see if you plot other interest rates, they also adjust. When short-term interest rate being increased, other interest rates also increase to some extent. But gradually, the change in interest rates, short end being increased by 100 basis points, that means 1%, but long end would have been increased by 20 basis points, 1/5 of a percentage point, because you know, because of the increase in short-term interest rates, future inflations are now checked. If not, the interest rate increase would fight inflation to be lower in the future, because consumption would become costlier and people would not demand that much additional expenditure in the market. So that would fight the interest rates to adjust downward, and also expectation build in the market that central banks are trying to put brakes to inflationary expectation, inflationary pressures by increasing interest rates. So what happened is people tend to delay their demand in terms of today now interest rates are high, so why should I will wait till interest rates become lower in the future. So the demand itself reduces in the market. As a result, increasing prices tend to halt or reduce. In fact, it's not necessarily reduce, at least it checks. It stops there. So what happened there is inflation being addressed to interest rates adjustment by most of the central bank, among other measures, and then short-term interest rates being pushed up. We will see those stuff in curves which try to explain it. So through which you find higher short-term interest rates and lower long-term interest rates, yield curves are sloping downward. But when the short-term interest rates are low, central banks also maintain low short-term interest rates to encourage people to spend, engage in economic activities, thereby let the economy to grow, more production to happen. So then what happens is long-term interest rates become high. So it's an upward sloping yield curve. But there is another explanation that tries to explain yield curves are almost always slope upward, irrespective of any other concern. Yield curves are upward sloping. Here, they try to explain it through time premium. Longer the duration, more uncertainty. Okay, so if you look at 1 year, from today to 1 year, and 5 year or 10 year, more unknowns could happen in 5 year and 10 year than 1 year from now. So as a result, whoever invests for 5 year, whoever wanted to invest for 10 year, wanted an additional risk premium. So this makes future long-term interest rates higher. You look at today's interest rate structure, 1 year would be lower than 5-year and 10-year, simply because the future uncertainties in terms of probabilities that could happen, they have factored into the yield expectation. So as a result, yield curves are always upward sloping is another explanation these theories try to explain. So we will try to get into each of these major theories and try to understand how they are explaining these in their analysis. Any further questions? Right. So you see here, three theories that explain the facts that we have looked at in the previous slide. Yield curves move together. Then when the short-term rates are lower, yield curves are upward sloping. When short-term rates are higher, yield curves are downward sloping. And the third fact, yield curves are upward sloping, irrespective of any other considerations. So the three theories that try to explain these facts are, one is expectation theory. Okay, so it tries to explain the first two, but not the third. Then you see another concept, segmented market theory, that explains fact 3, not the first two. Then you see preferred, if not liquidity premium theory. That combines the first two and explain all three facts. And widely used among all these things is the expectation theory in all analysis and all literature that you will familiar in this respect. So this is a very interesting explanation and understanding in terms of why these yield curves take this shape, that shape, would be looked at through these three theories that you are now seeing in the screen. Okay, so expectation theory, segmented market theory, liquidity premium theory. So these theories explain these concepts, and we see here short to long term, short, medium to long term interest rates in US. Long term, 50 to 2010s. It's a 60-year interest rates behavior. This is not a yield curve. Please understand, this is not a yield curve. Sometimes I have seen people who are economists, pundits, they know everything, but come and say this as yield curve. No, this is not a yield curve. This is a time series behavior of different interest rates of different maturities, but more or less identical characteristics. US government papers. This is a 3-month. Light green, 3-month US Treasury bill. That's a short term. Usually shortest term government paper in many countries, that is a 3-month Treasury bill. Then you see the light blue, that is 3 to 5-year US Treasury. It's a medium term, light blue. And then you see the red, that is a 20-year US Treasury paper. So at any given moment of time, let's say 1970, or let's say 2000 here, A yield curve is like this. You have to draw a straight line like this. And the points here, even 2000, I'm just looking at a year here, but effectively it's the date. And even within the date, it should be a time. Let's say 12 o'clock. We draw a line here. 3-month rate is here. 5-year rate is here. 20-year rate is here. It is upward sloping. 3-month rate is short tenor. Rate is lower than 5 and 20-year. Can see 5 and 20-year. Those are long term, medium and long term. Those rates are higher. So short term, medium term, long term. So if you plot these in the x-axis, what you are seeing is 3 months, 5-year, 20-year. 3 months is here, 5-year is here, 20 years is here. It's an upward sloping yield curve if you look at this. So yield curves are actually a line drawn to each point here. That's upward. But at the same time, you see, I was mentioning, explaining to you all, short-term rates are higher than long-term rates. Here, see, 1918 US, where the oil price shock driven inflation. US had oil price shocks and inflation was very high. See the short-term interest rate here. 3-month rate is almost 15–16%. Then you see here long-term interest rates here, red line, 20-year interest rate, it's about 11%. This is 16, this is 11. So if you draw this yield curve, it is a downward sloping. And here you see in 1968, like, all interest rates are together. It's a flat. Short term, medium term, long term, all interest rates are same. But now, more or less in recent years, short term rates are almost closer to zero. Even now, 20 years interest rates in US is about 2%. 5-year, 3 to 5 year is about 60 basis points. Right? So you see mild upward sloping. It's still upward sloping, but mild, not steep upward sloping. Here it is reasonably steep in 2010-11. Short-term rate is almost zero. 5-year rate is about 2%. And 20-year is about 4%. So you see upward sloping, very clear upward sloping. Here also in 1992-93, upward sloping. Generally, it is upward sloping. But at different times across this period, you can see all yield curve shapes exist in US, like many other countries, even in Sri Lanka, it existed. You see at different points in Sri Lanka also, you can see treasury bill rates were 20%. Even in 2008, 7-8, treasury bill rates, 1-year rates were almost 18–19%. You go and see the annual reports. And inflation also very high during that period. That's why I said, when inflation is high, central banks push the interest rates up to make inflation, future inflation, to come low. So then you try to find a situation where yield curves tend to be inverted. But now you see where the interest rates are, even in Sri Lanka. Treasury bill interest rates, 1-year rate is, 3-month rate is only 4.6%. 10-year rate is about 7.5%. But sometime back, 1-year treasury bill rate in Sri Lanka is 20%. Even in US, 3 months treasury bill is about 16%. At different points in time, you see the interest rates behave differently based on economic conditions, economic circumstances, inflation, expectations, all things being factored into. So that's why we try to learn these things through these concepts, these theories, those elements that we wanted to figure it out here would tell you why the yield curves take these different shapes at different points in time. So by looking at these, by learning these, you will be able to rationally explain these. Okay, any questions before I move on? So you see here, expectations theory. So what you are seeing here is, from a perspective of interest rates, the interest rates on a long-term bond will equal an average of the short-term interest rates that investors expect to occur over the life of that long-term bond. It's a very straightforward element. What it says here is, long-term bond interest rates are nothing but the average of short-term interest rates that occur during the life of that long-term bond. If it is a 5-year bond, you take 1-year interest rates and a 5-year interest rate. But what the 5-year interest rates that you are looking today is nothing but the 1-year interest rates, average of 1-year interest rates that occur in 1-year cycles up to 5 years from now. That means 2020, you invest 1 year, and 2021, you invest 1 year, 22, 23, 24, you invest 1 year each. So 20, 21, 22, 23, 24, 5 1 years. What is the interest rate that you are investing? That's the expectation that you build. And average of these interest rates are equal in 2020 5-year interest rates that you are trying to invest. So you look at 5 years from now, invest today for 5 years, and you look at it from the perspective of short-term interest rates that's happening throughout this 5-year period. So you take the average of that, you find today's 5-year interest rates, and you try to see whether that is attractive than what short-term interest rates that could happen in the 5-year time duration. Okay, it's a very straightforward. You look at it from a perspective of future interest rates in line with today's short-term interest rates. So it's explained, long-term interest rates are nothing but the average of short-term interest rates that occur during the life of the long-term interest rates, or the long-term bond in this case. So here, because of this reason, buyers of bonds do not prefer one bond to the other. They are indifferent, because you see, you invest 1 year today, or 1 year from now, you probably see the interest rates that you can get is no different to investing 2 years today. 2 1-year cycles, so 1 2-year cycle today itself. because interest rates are same. So they are indifferent. So because of this reason, they always see which, on the basis of your short-term interest rate expectation to the future, whether a long-term bond is attractive or not. So if it is attractive, you will buy, and you will not buy short-term because you are indifferent. That's why I have left here in this slide some spaces for you to fill if you want. But the simple meaning is that bondholders consider bonds of different maturities to be perfect substitutes. Eventually, whether it's a 1 year or a 5 year, in the eyes of investors, they are perfect substitutes. And I'll get this with a small number, so it will be much more easier and much more clarity in terms of understanding. So what you are basically seeing here is, right, if the 1 year bond rate today as, let's say, 6%, and you expect 1 year interest rate next year to be 8%. Okay, 1 year interest rate now is 6. 1 year interest rate 1 year from now, that means 1 year interest rate next year is 8%. So then you look at the 2 year bond today by looking at today's 1 year rate and 1 year rate 1 year from now. So today's 2 year interest rate need to be the average of these 2 1 years that we looked at. 6% plus 8% divided by 2. 6 plus 8 is 14. 14 divided by 2 is 7. So whether you are buying 1 year bond now at 6% or 1 year bond 1 year from now at 8% is no different to buying a 2 year bond today at 7%. Okay, so if the 2 year bond now you are seeing at 7%, you are indifferent. If the 2 year bond is lower than this 7% today, you would not buy 2 year bond. You simply see 1 year investment is attractive. Because today you are getting 6%, next year you will be getting 8%. Please remember, next year is an expectation. So you invest today at 7% if you see 2 year bond in today's market. If 2 year bonds are more than 7%, you immediately see 2 year bond is attractive. So you go for 2 year instead of 1 year. So what happened there is the behavior of investors, because of this indifference, makes any arbitrage, any difference of these expectations to bring back